I'm Songezo Zibi, and this podcast was recorded on Sunday, 15 August 2021 on Twitter Spaces. It is part of my Sunday conversation series about key national policy and political issues that I believe South Africans need to know and care about, as they are crucial to how we begin to shape a better future from here. I spoke to the governor of the South African Reserve Bank, Lesetja Kganyago, about the mandate of the bank and various aspects of monetary policy. In recent years, the bank has been the subject of public debate, much of it ill-informed, as South Africa continues to grapple with socioeconomic hardship and various actors in society look for solutions that will make life better. I began by mapping out the history of the bank and then asked the governor to provide his own historical perspective. Please take a listen.
Governor, I am going to, by way of introduction, just share with everybody that the Reserve Bank is 100 years old this year. In fact, the first meeting of the South African Reserve Bank, its board, was in 1921. It was in the Union buildings, and I think it happened at the back end of May. And the business that it dealt with was really basic: where to locate itself, because it didn't have offices at the time. They had a governor, a gentleman called Mr. Clegg, who came from the Bank of England. He had been born in Bloemfontein, moved to the UK, eventually worked at the Bank of England, and then came back to South Africa as governor of the South African Reserve Bank, its very first one. I think a lot of us know the eighth governor. Recently, our finance minister is probably, apart from the current governor, together the current governor, those that we know quite a lot, because the current governor is always known. But that's how many governors we've had over the years. I think others may know Dr. Chris Stals, who had one term before 94 and one term after 1994. He was the seventh governor and then succeeded by Mr. Tito Mboweni. I believe it was 1998 or 1999. I stand to be corrected. And so the South African Reserve Bank has been around for a very long time. It is, in fact, the oldest on the continent and one of the older central banks in the world. It was also modeled after the Federal Reserve of the United States of America. So I won't go into all of the deep history except to say it's an old institution. Its first office was where you have the National Treasury today. In fact, I think that underneath in the basement there, you can still find where they kept all of the money. But I think the money has now since moved to where the governor is in the tall building in Pretoria. Now, after 1994, we had a constitutional assembly that worked on the new constitution, and that constitution was eventually passed in 1996. It then went through a process of certification at the Constitutional Court, where a couple of things. In fact, in the section in which the Constitutional Court addresses the South African Reserve Bank is also a section that deals with other independent institutions within the South African constitutional framework. So before it gets to the South African Reserve Bank, I believe it deals with the public protector first, maybe mistaken, then it is the Auditor General, and then it deals with the South African Reserve Bank. It probably is the longest judgment ever delivered by the Constitutional Court. It's almost 300 pages long because it dealt with the entire Constitution. And I am going to read perhaps some of what the Reserve Bank was supposed to do, what the Constitutional Court said about the Reserve Bank. And for those who are interested, this is in paragraphs 166, I think, until 169. I won't read all of it, but one of the things the Constitutional Court says is that unlike the Auditor General and the Public Protector, the job of the primary purpose of the SARB is not to monitor the government. And I think we know what the other two institutions do. Its primary object is to protect the value of the currency in the interest of economic growth. The independence and impartiality of the bank, therefore, do not require the same type of protection provided to the other two institutions. But the Constitution provides that in pursuit of its primary object, the bank must perform its functions independently and without fear, favor, or prejudice. Now, that gets said about other independent institutions too, as you know, is in particular the public protector, who have been in the news over the years because of the job that they do. The NPA has got the same injunction and so on. So this is something that is said in the Constitution about all manner of independent institutions. So we now have the South African Reserve Bank as an independent. Its independence is protected by the Constitution, and its object is also stated in the Constitution. Now, Governor, where I want to start is that a lot of us started, especially those of us who are active on Twitter, started interacting with the South African Reserve Bank, or often interact with it as consumers of information when the Monetary Policy Committee completes its work periodically, and you stand in front of TV cameras and journalists and you tell us what the interest rate decision is going to be. But if you are you able to give us a sense of the ANC's own thinking on the South African Reserve Bank prior to the new constitution in 1994? Let me start there, and then we will come along the storyline. Governor, you can go ahead. Unmute yourself.
I don't know what the ANC's position is. What I would like to do is to recollect the discussions that took place when I was a young activist working on economic policy of a post-apartheid South Africa. And the discussions that took place in the preparation of the Durban conference of the ANC. It was the first conference after the unbanning of the ANC in the country. And one of the things we had to do as practitioners of economics was to formulate a resolution that was going to go to conference. And that resolution was captured in a little booklet, thingly called the Green Booklet. And in those debates, one of the things that came was that we actually need to make sure that you have got an independent Reserve Bank with a very clear mandate. And interestingly, at the time, there was a group of economists who were working with the ANC Department of Economic Policy, who had gone to Europe to look at what central banks are doing and what the configuration of the central banks was there. A debate ensued, and the relevant clause that talked about the independence of the Reserve Bank was removed and said that it needed further work. I was then fortunate that a few months later, I was then asked to be part of a delegation that went to Germany to look at the institutional settings of the Deutsche Bundesbank. There were a couple of people who were sent around the world. Others had gone to Asia. I subsequently had to go to the US and Canada as well to look at the institutional setup of the central banks there. So when eventually the constitutional negotiations started, there was what was called a finance group within the constitutional negotiations, and that finance group was led. Discussions were led there with people like Tito Mboweni, Trevor Manuel, Maria Ramos, and a number of people who were involved in them. By that time, the studies from all over the world had been synthesized, and a formulation was then made of the thinking of the ANC then of what the institutional settings of the South African Reserve Bank should be in terms of the constitution. By the way, the group at CODESA that deals with this, it was called the Transitional Executive council that had to deal with that. And so a formulation was made. There was a big debate about this. If people would recall, was that in the 80s, the previous government was faced with an important by-election in Springs, and word had it that the Reserve Bank cut interest rates just before the elections, and immediately after the elections, after the government performed well, hiked the interest rate again. And so there was a fear that unless the central bank has got sufficient independence, but importantly that it's made accountable, that it could actually be abused going forward and could actually lead to problems for the country. And so when the constitutional principles were thus agreed, one of the constitutional principles had to do with an independent central bank whose duty it would be to preserve the value of the currency. And that is what led to the current wording that you have in the Constitution that says that the primary object of the South African Reserve Bank is the protection of the value of the currency in the interest of balanced and sustainable growth. So that was the genesis of or the build-up towards the institution that you have today in terms of its independence and how it found itself in the Constitution.
Thank you, Governor. So just to be clear, so am I correct in saying that because the independence of the South African Reserve Bank is guaranteed in the Constitution, does this mean that when you guys as the Monetary Policy Committee decide on that or any related policy, you do not have to consult its shareholders?
Not at all. Not only do we not have to consult shareholders, we don't have to consult government. And maybe it will be important for the participants here tonight to also appreciate this, that prior to the current setup, the Reserve Bank, almost like the Bank of England, also had to seek the approval of cabinet to make decisions. I think the Bank of England only had to seek the approval of the Chancellor of the Exchequer. And as we celebrate the 100 years of the independence of the Reserve Bank, one of the interactions we had was the experience that Dr. Stals had in having to convince the president that, Mr. President, I actually do not need to come and brief you before I make decisions on this. The constitutional setup that we have now meant that the Reserve Bank could make these decisions without having to go to seek the permission of cabinet. But you raise the important issues of the shareholders because prior to the Constitution, what you had in the Reserve Bank Act was that the board of directors had the responsibility, and it delegated the responsibilities to the governor, and the governor could subdelegate and so forth. What we have in the current setup is that the primary responsibility for monetary policy is not with the board, but it is with the governor and the 3 deputy governors. That is what is in the legislation. And of course, the governor and the 3 deputies could then invite other staff members of the Reserve Bank to be part of the Monetary Policy Committee to assist the governors in executing their responsibilities in setting the appropriate monetary policy stance. So the shareholders, there is a history to it, but the shareholders have got no say on monetary policy. They have got no say on the spendings of the Reserve Bank or how the Reserve Bank generates resources. They have got no say on financial stability. They have got no say on bank supervision. The shareholders were a creature of the aftermath of the crisis, but also the fact that when the Reserve Bank was created, banks used to issue their own bank notes. And in order to get them over the line, banks were allowed to take shareholding in the Reserve Bank and give up their right of producing their own notes. But then the way in which the Act was written such to constrain the ability of any shareholder to influence or decisions at an AGM, for example. And the decisions, I will come to that later, that have to be taken at the AGM is simply to approve the appointment of auditors and the remuneration of auditors. That is it. That's all that the shareholders do at the AGM. The rest of the decisions are decisions that are taken by the executives of the bank. But then no individual shareholder is allowed to own more than 10,000 shares. Well, what if Songeso and his buddies decide, let us all buy the shares together, and then we can create some form of a voting pool, and then probably then get the auditor's remuneration rejected at the AGM or something like that? Well, the Act says that when it is not just an individual shareholder, it's an individual shareholder together with their relatives or associates. So that you cannot capture the institution in that manner. So, in short, that's what the shareholders have to do. The shareholders elect 7 directors to the board of the Reserve Bank, and they approve the appointment of auditors, and they appoint the remuneration of the auditors. That is their business at the AGM. And as I had spelled out, the directors of the Reserve Bank, whether they are appointed by government or they are appointed by elected by the shareholders, have got no say on the policy area of the Reserve Bank. That responsibility lies with the governor and the 3 deputies, which are appointed by the President of the Republic.
Thank you, Governor. I am going to come back to how monetary policy is set and how you intersect with the finance ministry. But as you know, I've been doing research for the last year and a bit on the history of the South African Reserve Bank and other aspects of the SA economy. And I'm just sharing this now with everyone on this platform. So one of the opportunities I had to do was to speak to Dr. Crystals. And he told an anecdote, and I opened this transcript while you were speaking, and he tells exactly what happened. How hurtful he got of taking things to cabinet. So he says, my predecessor Gerard de Kock introduced a practice of discussing these money supply targets with the cabinet. The Reserve Bank had to submit annual targets for the money supply to the cabinet. He says, I did that for the first year after I became governor in August 1989. I prepared the targets, submitted and explained to cabinet. I did it again the next year, but felt uncomfortable about this. After that meeting, I took the matter up with Mr. de Klerk, and I said I really didn't think it was right for the Reserve Bank to get the approval of the cabinet for these targets and so on. And then he said, before he could finish his explanation, he said, de Klerk said, Dr. Stals, what you want to tell me is that you do not want to submit your targets every year to cabinet. He said, I said, yes. He says, you also want to tell me that the cabinet doesn't understand what the hell this is about in any case. So that's the story that he told me and my fellow researcher. But before I get to the setting of the monetary policy, still on Dr. Stals, during that process, I read a lot of media coverage at the time. And when Crystals came in as governor of the Reserve Bank, he was interviewed by the Financial Mail. And he said that inflation was South Africa's public enemy number one, was South Africa's number one public enemy or public enemy number one, he said. And as we know, we now have a policy of inflation targeting. And I want us to talk about it. But before I do that, you've fortunately been Director General of the Treasury. You were there for quite a long time. And I would like you to give us a sense of the process of development of the monetary policy of the country, because it is eventually set by the finance minister in consultation with the SARB. And I speak under correction, I think the finance minister sends you a letter to say what this is going to be eventually at the end of those consultations. Can you explain that process to us?
Monetary policy is not set up by the Minister of Finance. Monetary policy is set by the South African Reserve Bank.
Yes.
The Constitution says the Reserve Bank has got a responsibility of maintaining price stability in the interest of balanced and sustainable growth in the Republic. It goes on and says that, but there must be regular consultations between the bank and the Minister of Finance, and that is where the thing comes up. Now, technically, the way in which it is that the Reserve Bank has got the responsibility for price stability. It could go on and just pursue that. It doesn't need the Minister of Finance. It can consult regularly with the Minister of Finance. However, the Constitution just says price stability, and it doesn't define, it doesn't just say protect the value of the currency. And the question that comes in the protection of the value of the currency is, what exactly does it mean? And the mission of the South African Reserve Bank prior to the adoption of the Constitution read something like to protect the internal and external value of the currency, and it had some other wobbly language in there. And there lies the problem, because you see, then the Reserve Bank then defined the internal value of the currency to be price stability, and the external value of the currency to be exchange rate stability. Now, economist Ricardo Hausman likes talking about what he calls the Impossible Trinity. And the Impossible Trinity says that you can't control the exchange rate, or you can't have the fixed exchange rate, control inflation, and at the same time have an independent monetary policy. He calls it an Impossible Trinity. And so the authors of our Constitution said, look, the value of the currency is the value of the currency. If you say is the external and the internal value of the currency, is there maybe a third value of the currency? And the decision was it should just be to protect the value of the currency. So now when you said it's to protect the value of the currency, then that leaves the issue of inflation, because the value of the currency erodes over time depending on the level of the changes in inflation. And so what would be an appropriate inflation rate that is acceptable, given that we can't quite have zero because this thing is estimated, and deflation is problematic too because it could lead the economy into a downward spiral. And so what is an appropriate level of inflation for the country? And so Governor number 8 in that process felt that there must be an engagement with the Treasury on the inflation target. And so a joint team was then set up between the South African Reserve Bank and the National Treasury to advise the minister and the governor on what an appropriate inflation rate should be. And in so doing, this team looked at the history of inflation over time in South Africa, and the statement that Dr. Stals made in the 80s when he said that inflation was South Africa's public enemy number one was precisely because we had high inflation running around 15-18% or so, and as such, interest rates were also high because you had high inflation. And that is why he declared it South Africa's public enemy number one. And I think that he had said that in the context of central banking and the setting of monetary policy. So the team took account of the history of inflation in South Africa. It took account of the evolution of inflation globally. It took account of the inflation rates of countries that are comparable to South Africa. And bear in mind, when South Africa introduced inflation targeting, we were the 13th country in the world to adopt this framework. And when the framework was introduced, there was a reason we got to do these things, because prior to that, You had what was basically referred to as an eclectic monetary policy, where it was not clear whether the central bank is targeting money supply, credit, or it is targeting the exchange rate, and so forth. And when the inflation targeting framework, when we were debating this question in 1999, it was after the Reserve Bank in 1998 blew all the reserves of the country and created a huge net open forward position. That net open forward position was simply described as South Africa's overdraft with the rest of the world in dollars. And so we had that net open forward position that we would have had to pay at some point or the other. And we felt that we needed a clear anchor for monetary policy that is aligned to the Constitution of the Republic of South Africa. Cut a long story short, a report was then tabled to both the Minister of Finance and the Governor of the Reserve Bank. There was a meeting which I was privileged to be part of, with a suggestion that said that instead of having a formal agreement between the Minister of Finance and the South African Reserve Bank, that rather there should be an exchange of letters. So many people think that there is a letter from the Minister of Finance instructing the governor. In reality, what happens is that the technical team made of both the staff of the Treasury and of the Reserve Bank advised both the minister and the governor. And once that agreement had been reached, the letter from the minister will go something like, well, I understand that our team have advised us these things. I think we must accept the advice. And if the governor confirms that, yes, that is the advice, he says that, okay, I will send you a draft letter. So the letter doesn't just come dry, cold. A draft letter is sent, and then the governor looks at the letter and says that I agree with the contents of the letter. It's negotiated, and then the minister sends it through. And once he has sent it through, the governor will then write back to the minister and I said, I accept the letter that you have sent to us. Behind the scenes, the Minister of Finance would go and brief cabinet about the agreement that he had reached with, or she had reached with the governor of the Reserve Bank. And then when the minister tables the budget, will make an announcement as part of the budget to say that the governor and I have agreed that this is the appropriate inflation target. So it's not about the setting of monetary policy per se, but it is about agreeing on the anchor of monetary policy, and in this case being what inflation should actually be targeted in this case.
Thanks, Governor. So there are two terms that you've mentioned. There's inflation and there's deflation. Just for completeness, Governor, can you tell us the difference between the two? Because I have a follow-up question then.
Okay. Inflation is a generalized increase in prices of goods and services. And the manner in which it is measured is done by Statistics South Africa. It looks at typical spending patterns in the South African economy, and then attach the weights to those spending patterns, and then put those goods in a basket and measure the change in the price of those goods and services. And that index that is compiled in that manner is then referred to as the inflation rate of the economy, and is basically an index. So inflation is the consumer price index. That is what we see is the changes in the consumer price index. That is what we call inflation. And so when we call it inflation, that means prices are rising. And when prices are rising, they erode the value of the currency. In other words, what we are actually able to buy as consumers get affected by what we had actually seen. So, give you an example. In 2018, about a loaf of bread cost 12 rands 95, and this is a loaf of bread It might be in a different supermarket, but this is what we had calculated at the time. And over time, if that loaf of bread, if that price of bread was to increase by 15% per annum, if it was to increase by 15% per annum, by 2038, you will be paying 212 rands for a loaf of bread. If that price of bread was to go up at an inflation rate of 8%, that loaf of bread by 2038 will be costing you 60 rands. If that loaf of bread was to go up by 6%, which is the upper end of our inflation target range, that loaf of bread would cost 42 rands by 2038. And if it was to rise by, which is the midpoint of our inflation target range, that loaf of bread will have cost 31 rands by 2038. Make your pick. If you are an inflation lover and you think that inflation it's okay for the Reserve Bank to pay 15%, by 2038, a loaf of bread it would be 212 rand. But in there also comes the issues of intergenerational equity. Because by tolerating this inflation, we are actually passing the burden to our children and our children's children. And so it is a very inequitable stance to then say that let us tolerate this. That is inflation. It erodes the value of money. Deflation works the other way. Theoretically, you would say that, well, if inflation is negative, which is what deflation is, then the value of money will go up. The problem, though, is that if today I go into a shop and I want to buy a pair of shoes, and a pair of shoes is costing me 1,000 rands today, but I know that there is deflation in this economy, and deflation, for argument's sake, is 10%, I would know that that pair of shoes within a few days' time cost me 1,000 rands less 10%. I will wait and not buy the shoes today and hope that I will be able to pick the shoes at a cheaper price later. Well, problem is that then the producers are going to say, can't make money here, they will stop producing. And then the economy will go into what is called then a deflation spiral. So deflation is actually as bad, as if not worse. And what you actually thus need is an inflation rate that society can tolerate such that it protects the value of the currency over time. And that inflation rate is important that it is in line with the inflation rate of countries that we are compared with or that we compete with, failing which it would be cheaper to source goods and services from those economies rather than from South Africa, and thus erode our own productive base. So I hope that for those who know this concept, just pardon me because I was told to be as basic as possible.
Thank you, Governor. No, we do want you to be basic. Now, I think one of the most common debates about monetary policy in South Africa is actually about inflation targeting itself, because some people say if we continue this inflation targeting, then we do not grow and we do not create jobs. You're quite familiar with it. What I want to ask, though, is that apart from inflation targeting, were any other options considered before we settled on inflation targeting?
Yes. And all those other options were the options that were tried before, not just in South Africa, but elsewhere, and had proved not to be conducive for us in South Africa, and actually in other countries led to disastrous consequences. So there are countries that target the exchange rate, for example. And if you target the exchange rate, I'm back to the Ricardo Hausman's Impossible Trinity. If you target the exchange rate, that means that you peg your exchange rate to exchange rate of another country. Once you have done that, you no longer have monetary policy. Your monetary policy is the monetary policy of those countries. That is basically what it comes down to. There was a time when central banks would then do what was almost saying that they target the growth in the money supply, and that growth in money supply was seen as a proxy that if money grows beyond this, it will lead to higher inflation. So if we want to contain higher inflation, we must get the rate of money supply growth to be at a particular level. The problem is that these things are intermediate targets. And why not go for the real target? Why do you go for intermediate? When and Bundesbank used to do, a number of central banks were doing this around the world. And when Dr. Stals was asked whether he has abandoned money supply targets before we even adopted inflation targeting, he said, no, we didn't abandon money supply targets. Money supply targets abandoned us. And the reason why he said the money supply targets abandoned us was that they had proved over time that their relationship with the actual outcome of inflation was problematic. And so New Zealand was the early leader in adopting explicitly saying that we will target the inflation rate. And then a series of other central banks around the world joined. Today, the majority of central banks target inflation. The only difference is what rate they are targeting. It is a framework that has proved to be robust and is being almost universally applied. But even those central banks that do not target inflation, if they are worth their salt, they will worry about inflation. And if they do not worry about inflation and say, well, inflation can go because we are targeting something else, they had found to come back to have to deal with the monster of inflation, because inflation erodes the purchasing power of money in the economy. But importantly, Songeso, is that you and I and many other people probably on this call, is that we rely on a fixed salary. And if you are a social grant recipient, you rely on a fixed grant. And if you're lucky, you might negotiate with your employer a salary increase that is slightly more than inflation, and in which case your real income is protected. But if inflation comes out higher than what you thought it would be, you are unlikely to negotiate with your employer to give you a second increase in the year. You will have to wait into next year. If you are a social grant recipient, you don't even have the bargaining power, because government just says, these are the resources we have, this is the increase we are prepared to give, and that's what you have. And if we do not have inflation that's controlled in this economy, you are actually putting the lives of working people, social grant recipients who are relying on fixed income, you are leading their lives to actually deteriorate in terms of its spending power, because their income is eroded by the rise in inflation that you would actually see in the economy.
Thanks, Governor. Let me ask, so how much do you guys know at the Reserve Bank, how much money to put out there? How does that work?
That is what was the big question in when we were targeting money supply. We had to estimate that every year. But that is not why we are looking now, because the target is in the inflation rate. So the money supply that goes into this economy has got to be consistent with the inflation target that we have. But I think for the benefit of the participants here, let me distinguish two things. There are various categories of money. And for many ordinary people, the manner in which they interact with the Reserve Bank, and you said that, so many of you guys on this panel, you interact with the Reserve Bank when we make an announcement about monetary policy. You're lucky. For many people, their interaction with the Reserve Bank is through the notes and coins that they have in their pockets, in their wallets, and in their handbags, whatever it is. That's how they interact with the Reserve Bank. But they also interact with the Reserve Bank through their bank accounts, and not because they have got a bank account with the Reserve Bank, they've got a bank account with their own banks. And when they withdraw money, deposit money, whether they swipe their card, whether it's a credit card or a debit card, and it goes through their bank and all of that, at the back of it is the backbone of it is the national payment system of the South African Reserve Bank. And I'm sure we will talk about those later. And the reason I am mentioning this is because although people interact with money being the notes and coin, the bulk of the money in this economy is not the notes and coin, is what are called, for all intents and purposes, bank reserves. And so this is digital money, and the banks, all the banks have got their accounts with the Reserve Bank, and that constitutes the biggest chunk of the money. It has to do with bank reserves. So when we set the interest rates controls the price of money. It controls the price of credit in this economy. And that in itself then determines the pace at which money supply grows in this economy. So we would not be able to sit and say, this is how much money we want to put in this economy. That's not how it works. That said, there is an exception. Should there be a shock to the economy, and we feel that the economy would need an injection of money through our reserves, through the bank reserves, and this not to be confused with the foreign exchange reserves, we can put the extra money in the economy using different instruments that we have. So last year, in the middle of the coronavirus shock, we did see that there was a dysfunction in the market. We bought government bonds, and by buying government bonds, we are thus putting cash into this economy. But we are buying these bonds from the banks, which means that we credit their bank reserves account at the Reserve Bank, and the banks are able then to continue lending in that manner. So that is just basically how we influence the money supply in this. It's a little bit complex than that, but that is the basics of how it goes.
So, Governor, tell me, why is it that, for instance, the United States, and correct me if I'm wrong, but why is it that in the United States, the treasuries can issue billions of dollars in bonds, and the central bank buys them, right? So why can't our government sell bonds to you guys? You guys can literally print money, and then we'd have all the money we need.
Of course, the Federal Reserve does not buy bonds from the U.S. Treasury. They buy the bonds in the secondary market.
Yes.
And so let's maybe for the benefit of the audience so that we can explain this. The U.S. Treasury borrows money in the bond market. They basically would issue a paper that says, I owe you and I will repay you in 3 months, 6 months, 12 months, 5 years, whatever, up all the way up to 30 years. I think that is the longest bond in the US. And so they run an auction. That auction is administered by the Federal Reserve of New York through a panel of primary dealers. And so the banks that are called primary dealers will bid at the auction to lend money to the US government, and they then hold the bonds. What has since happened was that the interest rates in the US went so low that they were close to zero, and inflation was also getting close to zero. And because of that, and what I had explained earlier on, that you do not want deflation, the Federal Reserve was trying to create inflation. They were trying to create inflation. And because they were trying to create inflation, they pumped money into the banking system. And how did they do it? They bought the government bonds from the banks so that the banks are sitting on a flush of cash. And the theory behind it is that by so doing, then the banks will find that they are sitting with this money that doesn't earn much interest, and that they will lend it to businesses and households, and thus generate economic activity. But we do not have a deflation problem in South Africa. Neither do we have inflation close to zero. And neither are we faced with a situation where we would like to create inflation. We don't have to create inflation. We have it. And our inflation, with the exception of the 2 months or so, was always higher than that of the US. And so we shouldn't come with the thing that would say that we must do what the US do. And, the Jamaicans have this saying that says that you can't do monkey see, monkey do with these kinds of things. And so you face this situation like we are facing. You can't try to do what the US does because you are not facing the conditions that the US is facing. But in the preparation for such eventuality, the South African Reserve Bank does provide for us to be able to purchase government bonds in the secondary market, and that we can do that or basically on our own terms, which is essentially what we actually do. So it's an instrument. This instrument that the US Fed has is an instrument that we also have, but we can only use that instrument if the conditions are appropriate for the deployment of that instrument. As things stand, our repo rate system is still very functional, and we do not need to get there. There have been other emerging markets, for example, that had done that to a limited extent, but that is because they were facing situations where their inflation was less than that we are actually facing in South Africa.
Thanks, Gavin. I'm going to ask you a couple more questions before bringing the audience in. One of the things I don't want to give a wrong impression that we can attack our economic problems in one track. In other words, if we pursue a certain monetary policy, it solves our problems, or a certain fiscal policy, it solves our problem. I understand that it's a bit more complex than that. A lot of things have to work together in order to produce an outcome. Now, in what a lot of us possibly do not remember or do not know is that when the ANC got into government in 1994, it inherited a mess. You spoke about the overblown overdraft that we had. The net open forward position was about $27 billion. There were many others. Exports were low. One of the reasons was that we had lots of strikes in South Africa. So the number of work days lost to strike action meant that we could not export as much as we needed to. And South Africa's economy was very export reliant, etc., etc. Now, you have had the unique privilege of having been both at the Treasury and also at the Reserve Bank, and also been there when we were trying to change our economic institutions in order to start seeing the kind of growth we saw in the early to mid 2000s. Can you, Governor, give us a sense of what sort of things need to work together alongside a solid monetary policy, need to work together in order to produce good outcomes from which all of us as South Africans can benefit?
Let me start by saying you're right, and monetary policy is no panacea to our problems. And so what you have thus is that central banks around the world have been very successful in the execution of their mandates. But central banks were created for a particular purpose to execute their mandates. But because they have been successful, we think we can use central banks to solve other problems. Institutions in a democracy matter, and quality institutions matter even more. And that means We need to design institutions for a purpose and spell out exactly what their mandate is so that they go through that. So, for example, South African Defence Force is to protect the country against external threats. They must fight the enemy that would come and do this. They do that. The courts must administer justice. The Office of the Auditor General must assure South Africans that there isn't fruitless and wasteful expenditure and all of that stuff. The National Treasury has been created to regulate public finances, to set the norms and standards of treasury governance. The South African Reserve Bank was created to protect the value of the currency. I guess you get the drift. Institutions get created in a particular constitutional setup, whether it's a democratic one or a non-democratic one, but created within a particular institutional setup. In the economic sphere, there are two important things, and they are interrelated, that have got to be understood. The first one is macroeconomic policy. And for us to get coherent economic outcomes, it is important that there is coordination of these policies. And that means that every institution has got to play its role in the interest of the greater good within its constitutional mandate. And so in macroeconomic policy, you have got that coordination there becomes because you have got fiscal policy and you have got monetary policy. Fiscal policy is the preserve of the treasury. Monetary policy is the preserve of the South African Reserve Bank. That's coordinating macroeconomic policy it's easier. Let me not say it's easy. It's easier than the other aspect. But macroeconomic policy, by its nature, plays a stabilization role. What drives key economic outcomes? What drives growth, employment, skills development, education outcomes, and all of that is in the realm of what we call microeconomic policy. So no matter what you do with monetary policy, no matter how often you would change the governance, monetary policy is not going to get this economy to produce the engineers that the economy needs. It's not going to get this economy to produce the accountants, that all of those. It is not going to do that. And so for you to realize rising levels, standards of living in the country, meaning you would like to see South Africans relying on their own ordinary participation in economic activity to earn a living, all of those other policies have to come together. It is characterized as more akin to conducting an orchestra. There are so many instruments that must be pulled, and that is why you have a national executive, because the national executive must pull all of those policies and ensure that there is an orchestra to produce what the conductor is actually looking for. And that conductor is the executive in this country, headed by the president. So to get growth, you need appropriate trade and industrial policies. You need a policy with respect to science and technology. You need an appropriate energy policy. You need an appropriate mineral resources policy. You need an appropriate tourism policy, and so on and so on. And those things are in the realm of microeconomic policy. So macroeconomic policy, which is fiscal and monetary, almost like set the parameters. And I'm putting these things consciously so that you could understand. Because if the parameters are not set, all the other ministries could just say that we would like to do all of these things. All that we need is money from the treasury. And you say the treasury does not have money because this is how much it can only collect in taxes. And then what you had asked, why can't the Reserve Bank then just print the money? And when that happens and the Reserve Bank just prints the money loses its value because you are just printing it. It no longer it's no longer as valuable as it was before that. And so in doing all of these things, and so I've spelled out these other areas of policy, we need to realize that we do not have the resources to do everything we would like to do. And so in making decisions, we need to avoid single issues narratives. So I am in this space, so I just pick this, and this is the most important. And the other one says, I can give you an example. Oh, no, I think it's education. Another one says, I think it's health. And another one says, I think it's that. Is that as policymakers, we need to frame the trade-offs for society so that society understands that there are choices to be made. And those choices have to be made by people who are elected by society and tasked with the responsibility to make those choices. To govern is to choose. To choose means that you must understand the trade-offs. Is it this or is it that? The choices you make today might affect different sectors of society differently. But importantly, we might be making decisions which look good today and benefit us today, but put a burden on the future generations. And so we have got to be cognizant of that policy making is about choices. Society cannot have its cake and eat it. There are no easy answers. There are only difficult choices to make in economic policy. And if there were no choices to make, trust me, we wouldn't need economists. The reason we have economists is because we analyze the choices that society must make. And as people who determine policy, we have got to be able to frame those choices for society. You can have this or that. You can't have both. Which one is it going to be? That is how it goes, Jonathan.
So, Governor, part of what I hear you saying, therefore, is that it is important that we get all our critical institutions to do what they are supposed to do efficiently, because we invest money in them. And if we invest that money, whether it is collected through tax or we borrow that money from the bond market or wherever, and we waste it, all that happens is that we do not get the outcomes that we are hoping to get because we have botched the other side, the other parts of the job. And secondly, the future generations for whom we were supposedly doing this will not have anything to benefit other than inheriting the problems that we have created. I will use a saying that I heard in Cameroon, which is where they explain this as a parable. That this gentleman said, in other countries, when people get a chicken, they let it lay eggs and hatch some of them and eat some of them. But in Cameroon, he said to me, we eat the chicken. So what you are saying is that we should not eat the chicken. We must learn to hatch some of the eggs and then to also use some of the chickens that come out of there to feed ourselves so that future generations may benefit.
Exactly. They probably would then, the future generations will eat the chicks rather than the mother chicken.
Yes. So Governor, one of the things I've always worried about is that we pay you to sign banknotes at the Reserve Bank and not do much else. Can you, before I take some of the questions from the audience, just tell us what else do you guys do there apart from interest rates and so on?
You sound like you've been speaking to my daughter. We asked her, what does your father do? She says, I'm not sure, but I think that he sits there the whole day and signs the money.
I am a similar
And no, I sort of like touched on it, that people think that we just deal with inflation. We do more than that. We're responsible for financial stability, the stability of the entire financial system, which is the financial system is to a modern economy what the heart is to the mammal. The financial system stops working, the economy collapses. The heart of a mammal stops pumping, the mammal is dead. And so we have got this responsibility of preserving financial stability in our economy. As I said, we run the national payment system, which enables South Africans to transact and enables settlements to take place in this economy. For those of you with, you also put money in your banks, we have got a responsibility to protect the interests of the depositors. And so we prudentially regulate banks to make sure that they have got adequate capital so that when you come for your deposits, your money is there. We regulate prudentially the insurers so that when you have taken a policy and you say that I'm taking a policy and that should I die, my family should be taken care of, that the insurer will be able to meet those obligations. And then, of course, we print banknotes and we mint coins. We also produce financial statistics, and importantly, we also manage the foreign exchange reserves of the country. You see, when we are busy tackling COVID now, we have got to buy vaccines. These vaccines are sourced from wherever, the US, Europe, in foreign currency. And because they are sourced in foreign currency, we need to pay for them in foreign currency. And the Reserve Bank ensures that there is adequate foreign currency so that when the economy needs to source goods and services from overseas, there is foreign exchange to pay for those. So that is who we are, Singers.
Thank you, Governor. So I have a few questions from Twitter, which I am going to read to you. Tandukolo Sangoni says, may you please ask the governor to repeat the line about the swiping of credit cards? I missed it. I think that the national payment system issue is important. Maybe let me deal with that. And correct me, Governor, if I'm wrong, but when I am traveling in any country in the world, I am able to swipe my credit card and secure what I want or buy things from Amazon. And that whole thing is seamless. It takes seconds to do so. Or if I swipe at a shop and so on, I get the goods immediately. There is no delay. There is no going to the bank to cash a check and so on. You guys run that system that makes all of that possible. Is that what it is?
We run the domestic one.
Right.
So it's called the real-time gross settlement system. And so let me use an example like this and say that you have got a bank account here in Johannesburg with a bank that is here, and you are banking with bank A, and you are paying me, I bank with bank B, and you do an EFT, electronic funds transfer. You instruct your bank to pay that money to me, to my account. That bank, the money goes through the bank system for it to connect with the other bank. The system that connects them is the national payment system. That is what we are. That is what we are running. So even with your credit card, you have got a credit card. You go to a shop. The shop banks with bank A, but your credit card is from bank B. The shop, it will still take your card, it will swipe it, and the banks will, through their systems, communicate for the settlement to take place. Behind it is the South African Reserve Bank national payment system.
Thanks, Governor. Why is there a difference between the repo and prime rate? That's another question.
That's because we set the repo rate, we don't set the prime rate. And for some reason in South Africa, the gap between the repo rate and the prime rate had been like 350 basis points. It's been like that for some time. There had been studies that we have done to try and find out why it is so. But the prime lending rate is just a reference rate. We can change this thing. Your bank can literally, instead of saying to you, we are lending you money at prime, they can say to you, we are lending you money at the repo rate plus 350 basis points. They could say that. So there is a gap between those two, and there is an additional factor, and that additional factor is that not everybody borrows at prime. There are people who borrow at a rate minus prime, and there are people who borrow at rates above prime. And all those have to do with your credit standing. The banks compete on the basis of that.
Thanks, Governor. One last question. So, we had some conversations, and I think some prominent people, I think everybody who knows who they are, who said, well, let's do quantitative easing. And in fairness, we hear on CNN and BBC and so on, them talking about the European Central Bank and quantitative easing and so on. What is that? And why aren't we doing it?
Well, I sort of like touched on it earlier on, using the example of the Fed and how they are doing quantitative easing. And you're right now, because now we must explain what this quantitative easing is. Because earlier on, I talked about the conditions under which quantitative easing is done. But maybe let me explain what quantitative easing is.
Yes, please.
Central banks set the price of money, the interest rate. And so policy is then driven by the central bank changing the price of money. When the price of money drops so low that it is close to zero, the price of money almost loses its ability to influence the decisions of borrowers and lenders. And so the price is no longer as effective as it would have otherwise had been. Of course, we economists, we complicate this. We say that you are at the zero lower bound. That is what it is. It means that interest rates are so close to zero that they had become ineffective. So when you are faced with that, when prices no longer work, you start to use quantities. And so in utilizing quantities, you put more money in the system by buying financial assets. And you hope that that money in the system will then go to the borrowers that need it and then generate economic activity. There had been controversy about this. And I had attended this I was attending a Jackson Hole thing, and there were demonstrators for and against quantitative easing. Some group of demonstrators said that they are opposed to quantitative easing because quantitative easing is going to lead to inflation. Okay, fair enough. And another group said, no, they are opposed to quantitative easing because quantitative easing is leading to inequality. And said, what? So how does this thing lead to inequality? Says, no, when central banks buy bonds and other financial instruments, who is holding those financial instruments? The rich, of course. And so the price of those assets go up. And because the price of those assets go up, the rich make even more money. And so that what you are seeing is that then quantitative easing ends up fueling the rise in financial assets. So it is, some commentators argue that what we have seen with the rise in financial assets is not borne by the reality of real economic activity, but is actually driven by the fact that central banks have pumped so much money in, and people have bought these things. And what did you end up seeing? You saw a number of companies also buying back their shares because there is so much cash in the system. So it has worked to some extent, and for those who are interested, there is a report that was done for the House of Lords, which was chaired by the former governor of Bank of England, Mervyn King, which evaluated the performance of quantitative easing in the UK. It makes for very interesting reading. And then, so you asked the question, why are we not doing it? Well, I think that I had explained this earlier, that for us to do quantitative easing in South Africa, we must face the conditions that the advanced economies are facing, which is an environment where they thought they were going to have deflation, and that is not the problem that we have.
No, I get it, Governor. Thank you. So I have got two voice questions. The first one is from my co-host, Lorato Tsenkeng. He's going to ask this question, and then we'll go to Bohani. And Bohani, I think you joined last week and requested to speak, but we're wrapping up. So I'm very glad that you are able to ask your question. But let's go to Lorato first, and then we'll let the governor answer, and then we'll come to you. Lorato, go ahead.
Thank you, Songezo, and good evening to you, Governor. My question really is around the role of the Reserve Bank with regards to cryptocurrency, right? To ask, so what is the South African Reserve Bank position on cryptocurrency, both as far as or with regards to policy and with regards to regulation, considering that you are the prudential regulator? Thank you, Songezo.
Well, when you ask central banks, the central banks will say to you, and it's not just the South Africans, that these things called cryptos are not currencies. For them to be currencies, they must meet the following criteria. 1, they must qualify as a unit of account. 2, they must be a generally accepted means of exchange. And thirdly, they must be a store of value. There is no doubt that cryptos are a store of value. There is no doubt that they are being accepted as a medium of exchange, but not generally, only amongst the people who have the particular cryptos. But there are no unit of account either. And so they do not quite qualify as cryptocurrency. And you will find that in the commentary, there is a talk of cryptocurrencies and crypto assets. So the central banks will see these things as crypto assets rather than as crypto currencies. We did issue a guidance note, so for lack of a better word, a document rather, that spelled out our thinking about cryptos. And we did warn people about the risks attendant to that, because at the moment there isn't a regulatory framework to oversee the cryptos. There's already been a crypto heist in South Africa of some sort, and people have lost a lot of money. And when you say to people these things are problematic, they do not seem to accept that until they had lost the money, and then they come screaming at us and says, do something about it. And that is what we face. Cryptos are also having particular technologies that underpin them. And those technologies are dominated mainly by the blockchain technology. Our attitude is to separate the technology of the cryptos from the cryptos themselves and say the technology can be used for other things. And so 2 or 3 years ago, we experimented, we did a pilot within the national payment system where we used the blockchain technology as a backbone of settlement. And we were able to settle the transactions that we would normally settle in the whole day within an hour. And so we had proved to ourselves that the thing can work. And what we have now been doing, we have gone out to market to come with a central bank issued digital currency. We're asking how would these things be designed, and we are studying this. And this is the similar thing that is being done amongst a community of central banks. But we are clear that this digital currency will only complement the existing bank notes and coins. And the reason I'm saying that complement is that the bulk of wholesale transactions are taking place digitally. They are not taking place in the physical space. And that is where we are. The world over, central banks, authorities are grappling with cryptos. There is a worrying thing that we identified, which has to do with consumer protection. When these things go and disappear with people's monies, there are all sorts of problems. Secondly, whenever there is there are massive criminal activities, whether they are in the cybercrime or that, and then the people will say, I would like to be paid in cryptos because that is how they think they are going to disappear. So there are big issues there about combating money laundering and the financing of terrorism. And thirdly is that, well, if we have taken a view that these things are assets, if they rise in value, then and you hold them, well, you have got to pay tax on them. And so SARS is also looking at the tax regime because these things, if they are income to you, they have got to be taxed.
Thank you very much, Governor. Then the next person is Bohani. Please go ahead, sir.
Thank you. Thank you very much, Songezo, and your team. And thank you very much, Governor, for clearly articulating a lot of things today. I do want to take you back specifically to the mandate of the central bank, which is to pursue price stability. I know in particular you indicated that there had been a consideration around other objectives such as pursuing foreign exchange, price stability, as well as money supply. There had been a lot of commentary, however, in South Africa around pursuing maximum employment as another objective. In particular, the Fed, of course, identifies both price stability and pursuing maximum employment as what it calls the dual mandate. Would you please maybe shed some light in terms of what your views are on this and what the views of the central bank is, and if that would be suitable for this context? Thanks.
Okay, that becomes an interesting one because people talk of the Fed having a dual mandate, and the Fed does not have dual mandate. It has a little bit more than that. And let me tell you how it reads like. It reads like you must have price stability, maximum employment, and low long-term interest rates. Now, when you hear the Fed talk, they talk about full employment, and they are talking about price stability. Now, it's easy to measure price stability. And by the way, the Fed doesn't say full employment; it says maximum employment. So when you have to then deal with price stability, we know what inflation we can tolerate. We can measure it relative to the others and all of that. And so we would know this is the inflation target. But how would we know that the economy has reached maximum employment? It's surely not when everybody is employed. And the economists complicate this, and I will mention the thing, and then I will explain myself. They have come with a very interesting creature called the NAIRU. It's called the non-accelerating inflation rate of unemployment. And what that would entail for South Africa is that we must estimate what that NAIRU is for South Africa. In other words, what is the level of unemployment that we can have before inflation begins to rise rapidly? And there had been a big debate in South Africa about that. I think that the best we have done post-apartheid on the unemployment front was to reduce unemployment to around 21%. We have not been able to go below that. And so when we then talk of what is the level of unemployment that could lead to a rise in inflation, it probably might be closer to that. But could it be 15%? Could it be 10? Could it be 5? And so forth? Difficult to tell. What we do know is that for us to change that, we need to change the potential growth rate of this economy and make fundamental structural reforms in this economy for the economy to create employment. Giving the Reserve Bank the responsibility to drive the economy to maximum employment when all of those structural reforms are not taking place will be hoping against hope. And I do not think that it would be an appropriate thing to do. And that said, even a central bank that would have a dual mandate will behave like an inflation targeter. Because you see, when inflation rears its ugly head, public confidence jumps out and the currency becomes worthless. And because of that, every central bank, irrespective of other additional responsibilities it is given, any central bank worth its salt will know that dealing with price stability is an important issue. And that is why our constitution says the primary object is price stability. It then goes on and says the central bank shall do such other things as are ordinarily done by other central banks. And that is why we got given the responsibility for financial stability, bank supervision, prudential regulation, and all of that. It was because of that. And in a way, when you give an institution a mandate, you must give it instruments. And I do not think that the unemployment situation in South Africa can be solved by interest rates. Interest rates are at historic lows now, and we still had unemployment rise, and unemployment had risen because we had a COVID shock. But let's also get things clear in today's language, that when the COVID shock hit our shore, this economy had its own core morbidities. We had structural faults that we have not dealt with, that we know, that we have spoken about, but because structural reforms are painful, they force the trade-offs. There will be winners and there will be losers. What is important is that in the final analysis is the whole society that becomes the winner rather than just the interest groups. And so the realm of structural reforms puts a challenge to the political leadership to manage contestation in society. And managing contestation in society is not something that central banks are capable of doing, for we are just technocrats tasked with a particular responsibility. Yes, we have succeeded in what the responsibility that we had been given, and thinking that, well, let us pile them with more responsibility will not lead to the kind of outcomes that we are looking for.
Thank you, Governor. Let me take a question from Twitter. And that question is, why can't the South African Reserve Bank lend at lower interest rates to the state, and that is national government and municipalities, for instance, and SOCs, to fund productive investment while demand, employment, and growth are too low?
The government does not have to borrow from the Reserve Bank. The government borrows from the market on a weekly basis, and there are a number of things that control the cost of government's borrowing. And absent those, failure to deal with those will lead to a rise in the cost of government's borrowing. And getting the central bank to do it is not going to do the trick. The design in this thing was very clear. Separate fiscal decisions from monetary policy decisions. By saying that the central bank should be lending to national government and provincial government and local government, you are saying that we must take fiscal decisions. Because when a bank lends to anyone, it will say to you, give me your business plan. So if we are to lend to the government now, we will have to say to the government, give us a business plan. Oh no, your business plan is not viable. Go and change it this way and that way and that way. And it is not going to work. It can't work in that manner. But let me come to the thing. What has led to a rise in government's borrowing costs has to do with the behavior of government itself. And that behavior is reflected in the fiscal stance. So the government, how the government collects revenue and how it spends it and how it sets the maximum that it can spend determines how much government must go and borrow from this economy. And the more it sets the quantity borrowed, the more costly it will be for the government to borrow. And so government have got to be able to set a fiscal stance that is consistent with the maximum resources available in this economy. This is a savings constrained economy, and the borrowers, all the borrowers, whether they are government or they are private sector, we borrow from the savings pool that is available in the economy. We might, when we do not have sufficient savings here, borrow foreign savings, which is what we do, by the way. And so, how did we know that we are faced with that situation? Is that the cost of borrowing by government had gone up over the past 3 years as government's credit standing with the lenders was declining. And I'm not surprised that now that government's credit standing has declined, the question comes, why can't the central bank lend government money? Once that is done, we are into the realm of what economists call monetization of the deficit, which basically means that we are just printing money to finance government expenditure, and government just goes and spends that money. And when that happens, that is when inflation rears its ugly head, prices begin to rise, the value of money is eroded, and guess what? You will be coming back to us and say, what are you doing about it? And by that time, it might be too late.
Thank you, Governor. I totally get it. We have Becca, who's going to ask a question. Go ahead, sir.
Hello, hi, thank you. Thank you, Governor, for making yourself available on Twitter for this discussion. My question is, South Africa has the highest levels of inequality in the world. I think we all agree. Do you agree with that? Are we? And if so, what role does this inequality play in stopping economic growth the way it should, or in hampering economic growth? That's my first question. And then the next question was, you said interest rates, or rather quantitative easing can only be considered the way it's being done elsewhere if interest rates have ceased to function, or have ceased to function the way they should. Are interest rates in South Africa functioning the way they should? And what reason do we have to believe that? Thank you.
Okay, the thing about inequality, there is no doubt that you can't have balanced growth if you have got such a significant number of our people not participating in meaningful economic activity. Without a doubt, when you analyze South African inequality, it is not just about the people who are earning so much and people who are earning too little. Our problem is we have got people who are earning so much and people who are earning zero. Taken to its logical conclusion, the key driver of our inequality is unemployment. And so unless we create meaningful opportunities, and I said meaningful opportunities deliberately here, because if we just talk creation of jobs, we are going to get the narrative wrong again. Because you see, governments would think that they are creating jobs, but jobs are created by businesses. I don't know, there might be businessmen or women on this platform right now. Show me one businessman or woman who wakes up every day and say, my goal for today is I'm going to create so many jobs. No. You have capital invested and you must earn a return on that capital. And to the extent that the capital is put to work and you are earning returns on the capital and your business has to grow, the manner in which you combine capital and labor changes, and you might be having to bring in more labor. And because you must bring more labor, then employment is created. And one of the narratives that South Africa must build is a narrative that says that we have got to create meaningful economic opportunities, not just jobs. That when our young people come out of the schooling system, they are assisted not just to look for jobs, but they are assisted to create businesses. For it is through the creation of businesses that we will create jobs. And for me, that is a very important distinguishing factor that we will have to bring to the fore. Our national narrative that just says that we just want to create jobs. Yes, we must create jobs, but do we understand the jobs value chain? Job creation flows from economic activity. You need economic growth. Economic growth comes from business activity and all of those things. And we need to be able to understand that. And we need to understand that in driving that agenda of creating economic opportunities, there are trade-offs that must be made. And those trade-offs must be made by the people with a political responsibility to make those choices. And so on the interest rates, are they functioning? Yes, they are functioning across, whether you are talking about short-term rates or long-term rates. There was a point last year, April, where we were worried that the interest rates were not functioning, when we were seeing a dysfunction in both the money market and in the capital market. And the Reserve Bank had to step in and deploy our instruments in the money market by introducing longer term repos and additional windows during the day, and in the bond market by introducing a bond purchase program to make sure that the money markets and the capital markets continue to function. And I'm convinced that if we didn't do it by that time, we could have had a dysfunction, and then we would be talking of a different ball game here. And we had to do that because if the interest rate markets do not function, you can't execute monetary policy, because monetary policy works through the financial system. And for us in South Africa, our monetary policy implementation works on a collateral basis. And so if the markets are not functioning, you cannot attach the value to the collateral, and the collateral system becomes dysfunctional. And that is why we stepped in to make sure that financial markets continue to function.
Thank you, Governor. I'll take one more question here and then go on to the Twitter comments and then go towards the close, Governor. Riba, please ask your question. Riba, are you there? Okay. I think Riba may have an issue with his technology. Governor, let me ask a question from Twitter, and it's representative of about 10 to 12, which are about the apparent quadrillions that we were endowed with from somebody from overseas that you guys are apparently keeping in the basement at the South African Reserve Bank. Can you just set the record straight for us in respect of that issue, in short?
I think that the man who talked about it didn't even know how many zeros are in that figure, and somebody had to correct him and said it's 15 zeros. Let's set the record straight. The point of departure is to look at the balance sheet of the Reserve Bank. The balance sheet of the Reserve Bank is not even a trillion rand. So where were quadrillions in this Reserve Bank? Secondly, if it sounds too good to be true, it probably is too good to be true. Who is this fairy godfather that we have, who with quadrillions just waiting to give to us? It seems to be fitting a narrative that says that we think that there are easy solutions out there, and it is problematic. We do not have sufficient vault space to store that amount of money in the Reserve Bank. And when we mentioned that, I noticed that the narrative changed and said that this money is in the BIS for the benefit of South Africa. For the benefit of the participants here, the BIS did issue a statement and said the account numbers that these people talk about do not exist in the BIS, and that the BIS had never had any dealing with those people. Case closed.
Governor, the BIS is the Bank of International Settlements, is it not?
The BIS is the Bank for International Settlement. It is the central bank of the central banks. All the other central banks have got accounts with the BIS.
Right. Okay. So basically, what you are saying, in short, it's an impossible amount of money to be given to by any one person to South Africa or anywhere, and it was too good to be true a story in any event. Governor, I have my own question. So I follow and read Paul Krugman, and his column is one of his most recent in the New York Times. Don't let inflation anxiety undermine our future. I'm sure you've read it. And he talks about the debate between some economists, others saying, they worry that you guys as the central banks are not sufficiently vigilant of the inflation problem in the future, given the significant injection of liquidity, given the shock that we've just had, and that you will wake up too late and then start raising interest rates quickly and create a shock for us. Do you have a view on what he said?
I have not read the article, and I think my comms team is going to be very angry with me because they forwarded it to me towards the end of the week, and I banked it and I said that I was going to read it this weekend. But as I was preparing for this engagement, I should have made it to be one of my readings, but I didn't. Be that as it may, we are not anxious about inflation in South Africa as the South African Reserve Bank. Over the next 3 years, our own forecast shows that inflation will be closer to the 4.5%, which is the midpoint of our inflation targeting range. So we're vigilant to that. And that is taking place in an environment that the economy is recovering. And unfortunately, as the economy recovers, we keep on being hit by other shocks. Well, just as we thought things were going, we had the social unrest. And then just as we thought things were going, we had the Medupi unit getting blown and so forth. We just keep on having all of these shocks. But the trajectory for inflation in South Africa is not leaving us anxious. And should it happen, we will not hesitate. Should inflation threaten to break our target, we will not hesitate to deploy our tools. But our base case in the current circumstances, we are not anxious about inflation, and we think that inflation and the expectations of what future inflation is going to be is well contained. I have not read Krugman's piece, but I suppose that he was referring really to what is happening in the advanced economies, where inflation had been rising and had risen above their target. And the views of the major central banks is that these issues are temporary. They are a result of supply chain bottlenecks because the coronavirus shock had led to some of the businesses closing and some of the businesses running out of capacity and have to rebuild their capacity. And because of that this inflation would be of a temporary nature. But I'm sure you would have noticed that even the Fed had said that they are talking about tapering their bond purchase program. And that is central bank speak of we are watching.
Thanks, Governor. I'm just going to deal with a couple of issues because I'm looking at the time. And I'm going to put a statement to you, and you must correct me and then provide your own views. And that is on this debate about this on and off debate about the nationalization of the South African Reserve Bank and the kind of difference to our lives that would make. Am I correct in saying that the manner in which the mandate and the bank's independence is framed in the Constitution makes it immaterial who the shareholders are? Because just like the Auditor General and the others other institutions like the public protector that are independent, it does not change the mandate and independence of the bank, at its core. Would that be correct?
That is a correct statement, Songeso, and it is something that is being missed in the discourse about nationalization, and that the mandate of the central bank is spelled out in the constitution. So the government can buy out the shareholders, and after they have bought out the shareholders, the mandate of the bank will just remain the same, unless the constitution is changed. The mandate will just remain what it is, and so it's a discussion. It's a never-ending discussion, and I am not sure what even fuels it, because these shareholders, as I had spelled out at the beginning, they have got no say in policy. They have got no say in the running of the bank, for that matter.
Okay, thank you, Governor. Just for interest, so can I become a shareholder of the bank, and how does that happen?
You can. We have got an over-the-counter share trading platform, and you can still put your bid to buy the shares of the bank. It's also a function of whether there are people who are selling the shares. So you match the buyers and sellers, and that is how you get the shares. And just so that you know, you cannot buy more than 10,000 shares. And so if you bought your 10,000 shares, the dividend is 10 cents per annum per share, which means that your 10,000 will give you a interest end of 1,000 rands for the year. Yeah. So if you are doing it for investment purposes, I'm sure there are better investments you can find, but many people do it for sentimental reasons.
Thanks, Governor. There was a time in the last few years, and I think it continues even now, where in the Treasury, Mr. Ishmael Momoniat would go to Parliament a lot or be in the papers, and you guys at the bank talking about twin peaks. What is this twin peaks in the banking regulatory system? What does it set out to do?
It's an institutional setup of regulation, and what it means is that you set regulatory objectives, and then you structure your regulation based on those objectives. And the two objectives that we are having, big objectives, is the conduct objective and the prudential objective. And let me explain this so that people can understand this. The prudential objective has to do with the safety and soundness of financial institutions, and that is done in the interest of the users of financial services. And so it's called twin peaks because one peak deals with the safety and soundness of the financial institutions, and the other peak deals with the conduct of the financial institutions. In other words, how do the institutions interact with their customers? How do they treat their customers? Are they treating their customers fairly, and so forth? And that is done in the in the financial sector conduct authority. The prudential one is done in the prudential authority within the South African Reserve Bank. So that is in essence what the twin peak model is. There was, or there might still be countries that are having what is called a single regulatory model, which means that you put all the conduct and the prudential issue in a single regulatory structure. The UK used to do that. They used to have what was called the Financial Services Agency, I think it was called FSA. I think the Japanese have a similar one. The Koreans, there are still a number of jurisdictions that are having regulatory frameworks like that. So we chose this twin peak one because we believed that is the one that works best for our setup in South Africa.
Thanks, Governor. We've got one last question from audience. Oliver Dixon is on. He's going to ask a question. I'll ask one more, and then we wrap up by 8 o'clock. Oliver, please go ahead.
Thank you so much, Songezo. Governor, good evening. So I just maybe want to ask a follow-up based on the last audio question we got here. I forgot the person's name. Effectively asking a question about the relationship between inequality, economic growth, and the role monetary policy plays in that. And the answer you gave was an answer we hear very often, that if the economy grows, we create jobs, inequality goes down. And that answer is so often stated that it sounds almost incontrovertible, that economic growth leads to job growth. But at one point during the Thabo Mbeki era, we saw the economy grow above 6%, nearly hitting 8%. And for quite a while would grow above 3 and 4%. Yet very little job growth happened during the Thabo Mbeki era. In fact, at the end of the Thabo Mbeki era, many economists described it as jobless growth. The economy grew, but the jobs didn't match it. In fact, earnings didn't match that by much either. So why is it the case that at a logical level, economic growth is a necessary condition for job growth, but never sufficient condition? What creates that gap between the economy growing at a certain rate, but jobs just never going anywhere? One of the possible answers I've heard was that mechanization was prominent during the Mbeki era, and that may be a reason why the economy grew but jobs didn't grow. Has that fact changed, and is there something new that we now know 10, 15 years later that we didn't know then? And perhaps just a second question I just briefly want to ask, and you can answer this at as basic a level as possible. In 2019 at the Old Mutual dinner, I briefly interviewed you, and we had a chat about cryptocurrency and blockchain technology, and you had informed us that the Reserve Bank actually makes use of blockchain technology. But a lot has happened globally since that conversation with regards to regulations worldwide about, in relation to at least, cryptocurrency. Are you worried about the proliferation of cryptocurrency as an alternative currency for many people, perhaps not yet exploding in South Africa, but getting to a point where it becomes popular enough for conversation and might start exploding? Are you worried that the Reserve Bank may not have oversight of those flows of effectively value in the economy and may not be able to regulate that in a way that safeguards the economy against against currency price protection and all of that? And at a basic level, what are the discussions you guys are having behind closed doors about cryptocurrency, blockchain technology, and regulations related to that? Thank you so much.
Mr. Dixon, if there is a discussion going on behind closed doors, then you will not know about it, because we will close the doors and you will never get out. No, our engagement on the cryptos is actually a very public one. We have released a document which we, as I had said earlier on, we must engage with. We must engage with that document. There is going to be a proliferation because there isn't a standard. There aren't rules. There aren't regulations, and like many new things that crop in, regulators have got to familiarize themselves before they could set an adequate regulatory framework, and that is the challenge that we are facing. And as we spelled out in the document, we just spelled out that these are the areas that we have got to be looking at. So do continue to engage with us, and if you're interested, we also have an innovation hub in the SARB, and you are welcome to engage with them to see what is doable and what is not doable. And that includes, for example, a regulatory guidance unit, a sandbox, and an innovation accelerator, so that people who are genuine in this space and just wants to build the businesses, they could engage with us with that. And that is the utilization of technology in the financial space. But we still caution against cryptos because they are not regulated, and we think that a lot more people would lose their money because there are so many different players and can't even catch up with them. I do not share your views about South African economy having experienced jobless growth. The economy did grow it didn't reach the 6% that you talked about. We did get to 5.6%. That was close to the 6% that we have set for ourselves as the target. And I'm saying to you that we have not experienced jobless growth. But before I get to that, let me just make this point. I am sure it is possible for an economy to grow and not create jobs. But I can't think of one economy in the world that is shrinking and is creating jobs. The economy is shrinking, it can only destroy jobs. But just now the statistics. During the period from 2002-3 to the period ending around 2008, for every 1% growth in the economy, jobs in this economy grew by 0.6%. And so we said in economics terms that the South African economy had a high job elasticity. And so, which then meant if we needed more jobs, we needed to create more economic growth. And so unemployment declined from over 30% in 1995-96 to 21% by 2008. It was a massive improvement. By no stretch of imagination could anybody have called that jobless growth. And I remember having a debate in 2007 with a trade unionist that I respect very much, who said that, no, you are right, the jobs are being created. The question is, what quality jobs are those? And I said, that in itself was a very interesting conversation, that we started to debate the quality of jobs rather than the number at that time. That said, we didn't have jobless growth. So let's get things clear. I don't think that we will have the kind of elasticities that we had during that time. And part of it has to do with the conversation we must have, which has to do with the structure of our labor market and has to do with the rigidities that disincentivizes businesses from taking more people and instead look at alternatives to people. And it's a conversation that society must have. And that conversation is going to involve some painful trade-offs. We've got to be asking questions. We experimented, for example, with a wage subsidy. And that wage subsidy, we have learned lessons from it. And there was some momentum of jobs being created as a result of the wage subsidy. We could be asking ourselves, wage subsidy versus something else. That thing versus this. How do we get the jobs going in this economy? There are trade-offs to be made, as I said to you, with my trade unionist friend who said that, well, quality jobs, we want quality jobs. And the question that one of the trade-offs which we have is, could we trade quantity for quality here? Or is there a middle road somewhere? There are all these trade-offs that society must engage in. Once again, there are no easy solutions, only difficult trade-offs to be made. Society cannot have its cake and eat it. Our needs and wants are unlimited. The means to meet those needs are limited. All economies are resource constrained. And that is at the heart of the economic discussion, the scarcity problem. We cannot have anything and everything we want. We are constrained by the resources we have or the resources we have got access to. Society must make those difficult choices. And the political leadership of the society must help society to frame those, it must frame those trade-offs and get the society to understand what the trade-offs are. And if we are to do that, we will be able to create much better prosperity.
Thank you, Governor. I still have so many questions, but we've been going for 2 hours. And I want to give you an opportunity to make some closing remarks. There may be something that you felt in terms of the conversation was important to cover, and maybe we didn't because the question didn't come through. And then I will make my own closing remarks, and then we're done for the evening.
Oh, Songa, so you mean my closing remarks were not good enough? I've just given you your closing remarks.
No, if you've got nothing more to say, Governor, I'm quite happy to make closing remarks. But Governor, firstly, I would like to thank you for taking time on a Sunday afternoon and to prepare and miss Kaizer Chiefs and Mamelodi Sundowns going into extra time before we started, so that you could be with us. The reason we host these spaces is that we do not want to be what in the 1980s and 90s were called howlers, people who had a lot to say, but were not necessarily well informed about the things that they were talking about. Now, obviously, on these matters, there are lots of points of disagreement, and there may be points in future, having learned here and further, wanting to question you again and say, well, I don't agree with the governor here and over there. But at least we will have learned the basics, and that's what we try and do. So I want to thank you for being clear, for being patient. I certainly did not think that you were patronizing us at all. And the second thing I want to, so thank you very much, Governor. The second thing I want to say for everybody else's benefit is that we get the audio downloaded after 4 days. Twitter takes a while to upload it onto the archive. It takes usually about 4 days, and then we download it, and then we will post that link on here for those who missed it, and you are able to download it. You can also go to Spotify and look for Songs and Friends as a podcast, and then you will see all the previous episodes that we have done. I want to thank everybody who's been patient and joined and listened in on this conversation. I want to apologize to all the many requests for speakers and to speak and the tweets. I tried to get through a lot of them, but I couldn't get to nearly enough in the end. But I want to thank you for your patience and participation anyway. Thank you once again, Governor. Thank you to Lorato, my co-host, for assisting me in the background. And thank you very much to everybody. Thank you.
Thanks, Tongeso, and the participants.
Thank you.